Welcome to Alfonso Cajero, Financial Modeling Tutorials. Chapter 5. Accounting Fundamentals, Constructing Balance Sheets, Income Statements, and Cash Flow Statements. Welcome to our comprehensive guide on constructing balance sheets, income statements, and cash flow statements. Mastering these financial statements is fundamental to understanding and analyzing a company's financial health. Let's dive into the basics of each statement and explore how they work together to provide a complete financial picture. Balance sheet. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It is structured around the fundamental accounting equation: assets equal liabilities plus equity. Assets are everything the company owns that has value, including cash, accounts receivable, inventory, and property. Assets are typically divided into current assets, those expected to be converted into cash or used within a year, and non-current assets, long-term investments and fixed assets like buildings and equipment. Liabilities represent the company's obligations or debts. These are also divided into current liabilities, due within a year, such as accounts payable and short-term loans, and non-current liabilities, long-term debts like bonds payable and long-term loans. Equity represents the owner's share in the company after all liabilities have been deducted from assets. It includes common stock, retained earnings, and additional paid-in capital. To construct a balance sheet, list all assets, liabilities, and equity in their respective categories. Ensure that the total assets equal the total liabilities plus equity. Income statement. The income statement shows a company's performance over a period of time, detailing how much money it earned and spent. It follows the formula: net income equals revenues, expenses. Revenues include all income generated from the company's primary operations, such as sales of goods or services. Expenses are the costs incurred to generate revenue, including cost of goods sold, COGS, operating expenses, and non-operating expenses like interest and taxes. To create an income statement, start by listing all sources of revenue and subtract all relevant expenses to determine the net income or loss for the period. This statement helps assess profitability and operational efficiency. Cash flow statement. The cash flow statement tracks the cash inflows and outflows over a period, providing insight into how a company manages its cash. It is divided into 3 sections. Operating activities. This section shows cash flows from the company's core business operations, including receipts from sales and payments to suppliers and employees. Investing activities. This part reflects cash flows related to the acquisition and disposal of long-term assets like property, equipment, and investments. Financing activities. This section includes cash flows from transactions with the company's owners and creditors, such as issuing or repurchasing stock, borrowing, and repaying debt. To prepare a cash flow statement, start with net income from the income statement, adjust for changes in working capital, and include cash flows from investing and financing activities. This statement helps evaluate liquidity and cash management. Interrelationship of financial statements. The balance sheet, income statement, and cash flow statement are interconnected. Net income from the income statement impacts the equity section of the balance sheet and is also a starting point for the cash flow statement. Changes in balance sheet accounts affect cash flows, and the cash flow statement helps explain changes in cash balances reported on the balance sheet. By constructing and analyzing these financial statements, you gain a comprehensive understanding of a company's financial condition, performance, and cash management. This foundational knowledge is essential for effective financial analysis and decision-making. Thank you for joining this tutorial. Be sure to like, comment, and subscribe for more insights into accounting and finance fundamentals.